Hey there, everybody. Jason Moser, joined with my friend today, Brendan Matthews, here for another edition of Ask a Fool. Today we're taking a question from Brock, and Brock asks, how do you place a reasonable valuation on stocks like Amazon and Starbucks that trade at such a high PE ratio? How do you know when it's a good time to buy and sell these types of companies? Is it more the idea that you're investing in the company versus the numbers? Brendan, I think we talk a lot about some of these growth companies and high PEs and sort of how we get past that. With Starbucks and Amazon in particular, what are your thoughts there?
Well, I'll start with classifying Starbucks as a super high PE stock. If you look at its trailing earnings, you'll see it's trading at 461 times earnings. Now, why is that? The reason is they had a one-time lawsuit settlement with Kraft, which essentially ate up their earnings for a year, makes it look like they're trading at a huge PE multiple. If you actually look at their forward PE multiple, it's more like 22. So I wouldn't necessarily say Starbucks is one of these high PE stocks. Now, Amazon, it does have a higher PE. Forward PE is 78. And with these companies that are growing like that, I think what you have to do is sort of step away from a single attribute model like a price to earnings, or even to a certain extent a complicated DCF, and you just really need to think about the company, its management, its competitive advantage, its markets, and say how big do you think that this company could be in 3 to 5 years, and does paying a premium relative to today's earnings, is that justified by the growth prospects? And you need to do a mix of qualitative and quantitative work on the stock.
Yeah, I think you made a great reference there of qualitative and quantitative, and I think it's very easy for people to immediately fall in that trap of trying to peg a number on something, whether it's a PE ratio or the number that the discounted cash flow calculator spits out for you. I mean, those are all fine. But again, you need to take it in the greater context of the business, its leadership, its competitive advantage, what kind of future it has. Starbucks, for example, they sell coffee. They sell good coffee, and we know coffee it's an addictive product that the people are going to keep on buying. And then, Amazon does a great job of really playing into that longer-term trend of e-commerce, making our lives easier by getting things to us without even really having to think about it anymore. So yeah, I like that qualitative on top of sort of the quantitative that most people are stuck on.
But the other trap some people will fall into is they'll do no quantitative analysis. They'll just give up and they'll just look at qualitative factors, just the story. And I think that's a mistake too. It's a good idea to combine both, have a flexible method. And I think if you don't do that, you're not going to be able to invest in companies like Starbucks or Amazon that I think are both great companies and are going to be great investments if you get them at the right price. So I think you need to really combine both of those.
I like that idea. Thanks a lot, Brendan. Thanks for the question. And for more information, make sure to check out Fool.com.